We're gonna talk about some credit issues this morning, but to begin with, we've got a huge week in the economic front going on this week. You know, last week the Fed raised the Fed rate, so we've now got prime rate up at whatever it is, 7. So, you know, when you think about that, it was 3.25 back in December. So it's gone up quite a bit. But the news last week, everybody knew what the Fed was going to do. So the markets already were prepared for what was going to happen last week when the Fed raised the rate, because everybody knew the Fed was going to raise the rate. And they were pretty certain it was going to be a 3/4 jump, and that's what they did. So the markets didn't necessarily have a huge response because they all pretty much knew it was going to happen. They anticipated it. This week is different. There is a lot of economic news coming out this week that is going to affect rates, maybe better, maybe worse. The thing that's happening on Thursday is the big one. That's the CPI, Consumer Price Index. That's going to be the one that is going to really see, are we going to have another jump in rates? Is the market doing what we anticipated, or are we going to see rates go down? Because if CPI, if the inflation rates show a decrease by some favorable amount this week, we are going to see a softening on long-term interest rates, our 30-year and 15-year mortgage rates. If that CPI is not affected, if it's going to be basically where it was at the last 2 months, it could be rather ugly come Thursday afternoon, Friday, and into next week. Here's the difference between last week and this week. Everybody knew what the Fed was going to do. Nobody knows for sure what the CPI numbers are going to be. So what happens with what I call the market makers, those people who are driving the market between now and Thursday? And it's going to be called anticipation. They're going to be people that are going to dig in and try to get information on what the CPI number is going to look like. And as a result of what they think is going to happen, they'll start making announcements and doing things to try to move the market one way or the other. So this week will probably be somewhat volatile on rates in anticipation of what's going to happen on Thursday when the CPI number comes out. And again, if CPI, oh, good gosh, I hope it doesn't go up. If it goes up, we are going to have an ugly next few days. People say, Greg, do you think we get 8%? We're a long way from, well, I say we're a long way. Yeah, we'll be at 8% if the CPI number goes up. Why? Because that means that all the things the Fed's been doing isn't having an impact on inflation. Now, if CPI goes down a little bit, especially if it goes down below what they anticipate it might do, or if it goes down enough from what's happened in the last 2 months, we may see a softening. We may actually see some good things happen with interest rates, because that's going to say to the markets, the Fed's actions are finally taking hold. But again, difference between this week and last week. Last week, everybody knew what the Fed was going to do. This week, nobody knows what the CPI number is going to be until they announce it on Thursday. So we'll have some fun. Rip?
Hey, in your experience, just watching the Feds, I saw some of the congressional interviews with Powell, and just really hard question, how is this even helping inflation? How unlikely would it be that the Feds might come back around and go, let's lower it?
Oh, they are not lowering rates. No. There's no chance they are going to lower rates. Not right now. They can't. The only way to really, when you go into the economics, and I am not one of those, I read enough, but the whole economic thing, the way you're going to drive inflation back to a more normal level where we had it, because lending was so free, whether it was you and I as a consumer, a business, they put so much money into the markets. I mean, think about it once. How long ago was it where you could go buy a car with 0% down? How many of you familiar with something called a floor plan? If you're an automobile dealer, some of you are. A floor plan simply means the automobile, you see all those cars on automobile lots, used car lots, new car lots. The cars sitting there are not purchased. They're on what's called a floor plan, which means the owner of that dealership borrows money from someplace so that they can put those cars on the lot. That's called a floor plan. Well, those interest rates over the last 10 months have skyrocketed because the Fed's raised the rates. So what happens? It's hard to find zero down car loans today or zero down boat loans today or whatever it happens to be. Those are gone away. And they're doing that because they're trying to curb inflation. They're trying to keep prices down. One way, two way, slow down demand. And secondly, raise pricing on what it costs so that now that everything's, so you're going to squish the market, and that's going to keep, hopefully, inflation at a more modest pace. So anyway, but Thursday's a big day. So I'll be sure to put something out on Thursday as soon as it comes out and let everybody know, because I don't know if it's going up, going down, or staying the same. I do know this, it's going to be fun to see on Thursday. All right. What I want to talk about this morning, though, is credit, because there's so much going on with credit right now. It's interesting. In the last 45 days, at least at my office, we have had more inquiries to purchase property from people with credit issues than I've had in the previous 6 months. And I wish I could give you an explanation as to why that happened, but it just has. We're getting a lot of inquiries on people who want to get pre-approved, and we're looking at credit, and boy, they got credit issues. And some of you, we're working with some of those people to get that resolved. Instead of seeing an 800 credit score, I'm seeing a 601 credit score or something of that nature. And we can work through that. But so I thought what I would do, since if I'm hearing it, you got to be hearing it. You have to be hearing credit scores. So I thought, let's talk about credit scores for a minute and get some of the key points that some of you may know, some of you may not know. The first one, what I call credit breakpoints on scores. What I mean by that is, how familiar are you with where, for example, how low can you do a conventional loan for most lenders? What is the credit score break point between, after a conventional loan? What's the credit score break point? Anybody know? 640. I heard somebody say 640. 640. 640. If you go below 640, it requires something called the manual underwrite, and many, many, many lenders, including us, do not do manual underwrites on conventional loans. So typically a 640. Now, I haven't done a 640 conventional loan in a long time, because usually if it's that low, we're going to move them to FHA for a variety of reasons, which we're not going to go into today. But anybody know what the break point might be for an FHA loan? 580. Somebody else? Anybody else? 600. 600. Anybody else? I'm having fun with this. All right. So in actuality, FHA doesn't even have a break point. FHA doesn't. Lenders have a break point. The most common break points for lenders, 620, 600, 585. Those are the most common break points. And it's called an overlay. It's what a lender says. At my company, for example, my company says you cannot go below 600 on an FHA loan. If you do, you got to do a manual underwrite. Well, don't even bother with that. Have any of you tried to had a lender do a manual underwrite on one of your buyers? I know you have, Worrell, and that's just been a joyous experience, hasn't it? Yeah. It is a pain. That's why I don't do them. I'll help somebody get their score up and then do it through automated underwriting and not have to mess with manual. Manual's a pain. So the break points are there. Anybody know what USDA is? Because some of you do. Rip?
What?
USDA break point on credit score.
No, it's funny. I was going to ask if USDA was the same as FHA break point.
It's no, 640. Now again, most lenders are 640, right? You can go below that, but most lenders don't go below 640 on USDA. Anybody know VA? VA? VA is kind of like FHA, there is none, except most lenders have a break point. Ours at our company is 600. So there are break points, and it's just important to know that. Now, break points do not necessarily mean that everybody above 640 is going to get a conventional loan. It doesn't mean that. Because oftentimes, if you're at 660, 670, 680, you can get a better deal on an FHA loan than you can on a conventional loan. Somebody wants to put 3% down on a home or 3.5% down on a loan, and they got a 760 credit score. I'll try to do everything I can to convince them to put 5% down unless they qualify for the 3% down conventional loan. But assuming they don't, I want them to put down 5%. If they put down 5% versus FHA 3.5%, they're going to make that extra 1.5% up almost overnight. So your lender has to know those things. All you have to know is that there are break points and make sure your lender's advising your client properly. All right, on credit, pay down or pay off. If you got somebody who's got, credit cards, installment loans, things of that nature, and they want to improve their credit, one of the most common things they'll say to me, well, I'm just going to pay off everything. Do they need to pay it off? Chris, you're shaking your head no. And you're right, but why?
If you pay it off, you can get that account closed and it'll ruin your credit score.
Yeah, exactly. I'm going to talk about that. You don't want to get the account closed. But how far down should you take your debt? How far down should you take your debt? Anybody know the number, the magic number? 30%. 30%. 30%. In other words, if you have a credit card that has a revolving account, not installment, a revolving account, a credit card account, something of that nature, that has a $10,000 balance or a $10,000 high credit limit. As soon as you go to $3,001, it hits the algorithm and starts hurting your score rather than helping your score. So the magic number is 30%. At any time during the month, you never want that balance to exceed 30% of the high credit limit. If you can keep that below 30% of the high credit limit, and the trick is you want to do it on all your cards. Now someone says, but Greg, I've got all of these cards and my card utilization is only 27%. If you just add up all their high credit limit, and that's okay. But the best way to get the algorithm to work for you is to keep all of the cards below 30% of the high credit limit. So when I'm advising somebody and I'm looking at their credit, I'm saying, we're going to pay this one down, we're going to pay this one down, we're going to pay this one down, and whatever you do, do not let it go above 30%. Because here's the other side of it. Some people don't have enough cash to be able to pay it all off. I mean, that's devastating. I'd rather have them hold on to it. Let's get their score up, hold on to some of that cash so they've got it for a down payment or their closing costs or whatever it happens to be. So please, pay down versus pay off. Just remember 30% of the high credit limit. That's going to drive the algorithm to a positive number. If you've got somebody that's at 90%, on a card, especially if it's a big card and it's been up there a while, ooh, that could be trouble. Now, Credit Karma versus a full mortgage report. How many times have you asked people, what do you know about your credit scores? And what do they refer to immediately? Credit Karma or my Wells Fargo card or my Bank of America card or my Chase card. I don't get all three, but I get one of them or two of them and they tell me it's this. Is what you get from Credit Karma the same as a full mortgage report? Claire, you're shaking your head. No, you're exactly correct. But why? Do you know? Not sure? Somebody know? Why is it different? Go ahead, Jay.
I think Credit Karma is Advantage 3, whatever that means, and the other one is Advantage something else.
Well, partially. Here's what's different. There are 9 different algorithms that the bureaus use to determine credit scores. The mortgage industry, everybody in the mortgage industry uses the same algorithms. It's all the same. They're the most conservative. So I know this. Whatever you're telling me on Credit Karma, the benefit of that is where's it trending? If your scores have been trending up, then in all likelihood, your scores are going to be better. But if your scores have been trending down, that means you've got a problem. So trending with tools like Credit Karma and your credit card is good because it tells you the direction of your credit. But if you actually want to know what's happening with your credit and you're buying a house, now of course you don't need to get a mortgage credit report unless you're buying a house. But if you are, you need to have a full mortgage credit report. Now a lot of lenders today, including us, will do something called an in-file report, meaning that it's not going to be a hard inquiry to your report. And I'm not a great big fan of that. Reason why is I don't want something to change between the time I give you that information and the time you're going to apply and get a house and get a loan. It's not that big a deal to get a full report. It's just not. And it's not going to have a huge negative impact on your scores unless you're drawing credit. So these 3 things on credit are absolutely critical. First of all, know the break points, or at least an idea what the break points are. Secondly, we want to pay down. We don't necessarily want to pay off. And number 3, know that a full mortgage report is going to be a better tool to make sure your client is qualified. I got that. Okay. Next thing about a full mortgage report, it's something called trending. This started a few years ago. One of the parts of the algorithm that they use is trending. So somebody says, well, I'm just going to pay it all off right before I go to buy the house. Well, the algorithm now looks at what's the trend been on that card over the last 12 to 24 months. So if the trend has been utilization all the way up to 60, 70, 80, 90%, and all of a sudden it's down to 10%, that's good, and it'll be an improvement, but trending is going to have an impact. So when I'm advising people what to do with their credit, one of the things that I'll suggest to them is if they've got a card that has a $300 high credit limit, and they say, but I don't use that card much. And I say, okay, fine, but if you want to push your score up, I don't mind if you use the card. Be sure you use it less than 30%. Maybe just go buy a tank of gas or go to lunch. At the end of the month, pay it off, then go back and use it again. Because if the trend shows that you've been using that card and you're doing it under the 30%, what it says to the algorithm is, I know how to manage credit. That will push scores up a lot. For some of you, I've done work with people that have needed to get their scores up, and that's one of the tools that we have used to get their scores up. Sometimes it might take 4, 5, 6, 7 months, but that's okay. We'll get them into a house, and we'll get their score up from 610 to 650 or 650 to 700, whatever the case is. So it's not just knowing what the score is, it's how can we help them move that score to a place that's going to push their score up, and trending becomes a part of it. Chris, you mentioned closing accounts. Whatever you do, do not close revolving accounts before you get a mortgage. Do not. You can pay down a credit card, you can pay off a credit card, but do not close the account. And as Chris mentioned, do not let the creditor close the account on you. Because your score is immediately going to go down as soon as they close an account. And you don't want that. So you might have to keep $10 on the account, or $15 or $20. I don't care. But don't let them close an account if you're getting ready to do a mortgage. And I'm telling you that, and I almost screwed it up just recently for myself. My wife had to remind me, you better go use that card so they don't cancel that thing. So closing accounts can be kind of critical. And by the way, installment loans are not the same. Installment loans are car loans, recreational vehicles, loans of that nature. Okay, they're not a revolving. It's a set payment every month. It's got a term. You're going to pay it off in 48 months, 24 months, 36 months, whatever it is. That's an installment loan. That's not as critical. You can pay that one off. That's not as big a deal. Collections. There are so many times we see people with collections on their credit and they have no idea that they have a collection. Have you had a lender tell you that one of your clients said everything was fine and then they get to the report and they're wondering why they've got a score at 660 rather than a score at 720? I mean, and they say, well, look, I didn't know I had a collection. I probably see it at least once every other month that somebody says, Greg, my score's here. And then I look at the report and I see it's not where they think it is. And part of the other reason that happens is that collections are not always reported to all three bureaus. Some are not. So the ones that are not reported to all three bureaus, can you imagine if it's reported to two bureaus and then the third one it's not, and you go to do an inquiry and that third one is the one that has reported it and the other two didn't, the score is going to go down. So that's why I like doing a full report. I get it all the information. And collections can pop up and go away. If I can pay down a collection, it's hard to get a collection taken off of the report. I mean, the only way you're going to get a collection taken off the report is if the creditor agrees they made a mistake and never should have had it on there in the first place. That's the only way you're going to get it off. But most creditors, they've got a collection, it's probably legitimate to some degree, but it might only be for $54 or $120. If I can get that to a zero balance, my score is going to go up. If it's medical, don't worry about it. Just leave it alone. They've recently changed all kinds of laws and rules on what you can do with scores on medical collections. So medical, we don't get worried about in our industry. It's everything outside of medical. Does that make sense? But collections are a big deal. If I can't get it off the report, at least I can do is get it to a zero balance. And if you're wondering how much of a difference that can make, we closed the loan last week, Wednesday, for a lady who had if I recall, I'm thinking it was a 682 credit score. She had one collection. We got that collection paid off and got the verification, waited till it hit, score jumped up to 719. That really helped her on the cost of her transaction. So, and that was only about a 40-day window. So collections are a big deal. Late payments. It's not uncommon for someone who is perfect on making their payments to have a late payment on a credit card. It's not the end of the world. If it's recent, it's devastating to your report, to your score. If it's old, it may still be there, but it's not devastating. But late payments are a big deal. Have you had anybody say to you, well, I've only had one late payment in the last 6, 7, 8 years? That one late payment, if it's recent, is devastating. If it's not recent, it can be okay. But we don't want late payments if you can help it. And when you look at a full mortgage credit report, it tells you every month that it was late and how many times it's been late. All right, last thing. One of the things that I think is very critical as you are working with your clients is to make sure that whoever that lender is helping your client with their credit, even if they think they've got absolutely perfect credit. Now, if somebody's got 3 scores in the 800s, I just congratulate them and say, thank goodness, I wish I had more like that. But a lot of people don't have that. A lot of people are at that break point. They're at a 660 or 665, and I want to get them to 681. Or they're at 695, and I want to get them to 701, something of that nature, just to improve them a little bit. Please be sure that the lender that your client's working with is capable of walking them through a process to help move up their score. Because it's not just getting, the lowest rate may be at 701, not at 665. Is there a way to get them up there? Be sure you're working with people that have the ability to be able to do that. All right, thank you, everybody. I appreciate it.